Good evening. This is Ken at Tortoise Capital with a review of the weekend trading report for September 7th, 2019. Markets in bullish normal. Overbought on all the measures except for the 30-day look back, which is at the high end of neutral. It's like 1 point away from being overbought. You can see the holdings for September with the next reevaluation on or about 1 October. Current theoretical exposure in ETF2 is at 50%. Patreon experiment is now policy. It's working pretty well. Risk Z has been favoring the swing trade here since August 16th. We're going to take a look at that in a masterclass for the annual coaching program and show the interconnection between the Risk Z, 4 Seasons of MACD histogram, and the PSAR provided a very nice set of navigation tools for these past 3 weeks, which have been challenging. In the market mosaic, we're white bullish with price respect to the 200. Slope of the 50 is yellow bearish. ADX 14 is a neutral 19.5. The Risk Z just tipped over into risk on as of Friday with a score of 1.012. That gives a Risk Z score of 0.04. Weekly market health check. We're in the fall, in the middle of the Red River. We had a really nice week. We're getting ready to hit a PSAR flip breakout here. We have to get to about 305 for the RL10 to break out. We broke through the emerging dragon price level, though, at 298, with stops at the bottom of the dragon and the weekly low. I just noticed that PSAR grind has been effective here. And then this from the belly of the dragon to the belly of the dragon now. See that generally upward slope. Other support levels at Z3 and then at the belly of the dragon on weekly. On the monthly, we are still in a declining fall. However, I would note that the slope of the dragon is up. The 30 period Bollinger Band mean is up. The 10, the 30, and that 4 period RSI are all up. Pushing near to all-time highs above the real bodies of these candles. I would just note that this is where the RL30 rolled over, and that previous peak and the PSAR flip were right at that price level. So really above 299 or 300, and then above 305, it's all free and clear. PSAR flip has been helpful. This rejection of the bottoming tail with a affirmative move, and the winter has become spring and is starting to roll up. The big winners this week in the using the BMR look back, the 1 week and the 1 month. So this is sorted by the blended monthly rebalancing numbers, but the big winners were in the looks like buying things on value. So Latin America and emerging markets, whereas the previous winners, in the treasuries began to suffer, but it looks like tech, real estate, and the large caps still leading the way. Again, the looks like there was a fire sale here in Asia, less Japan, and Latin America. But Australia was fine. Emerging markets were fine. But consumer discretionary, power shares, tech, and regular tech, that's where the strength is. ETF 32 portfolio, we're seeing the same thing. Asia less Japan, China, Latin America. So these are all buying value, and extended suffering was rewarded. So the bottom feeding value pickers were doing well. Inside the Dow, the leaders tended to do pretty well. A couple laggards did really well. We were highlighting these opportunities during the week in the swing portfolios, and there were some good 1 day and 2 day trades inside here. But Intel, Nike, Cisco, and GE are ones to definitely watch for continued follow through. In the sector spiders, semiconductors, so that rewards our looks at AMD, SMH, Intel. Taiwan Semi, will continue to watch those. Is this just value picking at the bottom of the energy stack here, or the sign of maybe an energy turnaround? We shall see. ETF Max, gold, silver, wheat, and precious metals, all those suffered this week. But as you can see, the semis leading tech higher. The theoretical model improved to 50-50 on the asset allocation, with now 5 of the 10 indices on buy signals. That's price with respect to the 4-month moving average. Up from 2080, it's now 50-50. It's still the S&P at 58, better than EFA at 47. And then inside the U.S., it's tech, clearly, then large caps, then mid caps, then small. Energy lagging, tech and discretionary doing very well. Staples has been the other one that's been real value, but this shift to discretionary, maybe that's the sign of a flipping the switch on some opportunities. So we'll be watching those, watching that relationship. All the large caps, gold, silver, treasuries, those defensive plays still have some residual strength, but this could be that first week of that situation turning. Latin America's got a lot more room to go. I'm looking for green and white now as if this is truly a turning point. Then it's discretionary growth, and then losing some gains out of staples and minimum volatility. So that could be a shift more towards the growth opportunities now. Shifting to the daily report, nice rebound. We're going to see in the master class that this on the 16th of August, the risk Z flipped from winter to spring and began favoring the long side swing. And except for that 1 day in which hedging was really available, that was a really good early warning. That failure to fail further and the PSAR flip has been pretty good all the way through this swing trade. Now we're pushing up here at 299. It's got to get above the 300 mark for the emerging dragon, and then above 302 it's free and clear. Spring is getting ready to just enter the summer now. That's favorable. Top end of the 10-day trading range. You see how volatile that 10-day has been. It's 80% of the trading range of the 30-day look back. That's how vigorous that move has been. Warning signals for short side in Latin American emerging markets if there's no follow through. 10-day max pains. There's some Johnson & Johnson, Walmart, Boeing, and AXP for deep discounts and more quality plays. Plenty of dojis on Friday. It was relatively quiet. Johnson & Johnson, the only one testing out better than 2-1 on risk reward for the auto framer. Nothing in the RSI2. Plenty of breakouts. So Verizon, Home Depot, Visa. So Home Depot's been our number one pick. It's still continuing to go. I like it. In the ETF 30, lots of dojis. Gold showing some buy on dip opportunities, but again, I think that was a bit of 4 sigma move. I'm cautious about that one. Treasuries have already started to give back. Couple super pinches still in play. You can see Home Depot, Mexico, Nike, Intel, Verizon, all excessive stretches above their Bollinger Band mean. Only United Health is now well outside the river. The expanded pinch boxes, these are the ones that have been exceptionally trending. That's how you get a wide river. Johnson & Johnson testing out well on the auto framer. Top shelf, the most number of ATRs below their RL270. These are deep discount value plays. Agriculture, South Africa, Brazil. I'll be looking at Brazil. These are the most ATRs above their own RL270 or the long-term fair value, the relative strength leaders. I think most of those are due to rotate, though, in the defensive plays. But over here, Walmart, Coke, Home Depot, I'm still with them. I think there's room to play in Pfizer and Cisco still. And then ExxonMobil may be the beginning of that good longer-term position in energy, if that's a turnaround point. Lots of intraday squeezes to frame. I like that the S&P is at the top of that list. That says that range compression on Friday was extraordinary, so be ready for that sharp move out of that. I like that tech is there as well, and diamonds. So the whole market is postured for that breakout. Nothing in the winter in the ETFs. In the Dow now it's down to just Johnson & Johnson. These ones in the spring or in the summer are the relative strength leaders. Late in the spring might be some ones that are worth looking at as well, because they made the turn earlier than the ones that are early in the spring. These three in the fall, McDonald's, Merck, and Apple, never even got below the zero line, so there may be some residual relative strength there as well. Lots of breakouts on the 10-day NDX. Home Depot, you can just see the strength there, and in Visa. Mexico has been a real winner, as has consumer discretionary is now starting to move to the front. Excuse me. The fact that consumer staples lagged these last 3 days, to me, is potential for a changing of the guard. So the two defensive plays we've seen, staples and real estate, were not as popular as these others that had been lagging. So this looks more like buying things on sale. That's could be a shift in the volatility conditions, and we saw that in a risk Z, which just went into summer. So the declining volatility is certainly continuing to favor careful swing trading to the long side. Really nice move in the 10, but now it's already at above 2 sigma, and although the 30 and the 90 have both begun their hook, this wouldn't be unusual for this to stall, and it's coming up at a resistance level that the last time it got there and rolled over, it lost another $10 or 5% in the S&P. So we'll be mindful of that, but a breakout above that correspondingly would say, hey, free and clear. That's everything I want to cover for the weekend report. Keep your risk measured and your powder dry. I'll be adding a longer term or a longer discussion of the swing trade portfolio for the Patreon members next. So until then, keep your risk measured and your powder dry.